Exchange-traded funds, or more commonly known as ETFs, are growing in popularity because of their simplicity, cost-effective approach to investing, as well as the diversity they provide. Hundreds of new ETFs are launched every week, and while this is absolutely great news for investors, sometimes there are simply too many for investors to sift through one by one. Therefore, for our monthly ETF radar, we will be sharing some of the more prominent new ETFs that might be something you will be interested in.
Hello everyone, my name is Cyrus, and today I'll be showcasing some newly launched ETFs in August. Luxury firms can leverage their strong brand power and tap into an expanding array of growth opportunities brought about by a growing middle class. The global luxury market size is expected to grow roughly 50% between 2022 and 2030, according to Bain & Co. This will result in a total market size of more than $600 billion. On the 23rd of August 2023, Roundhill Investments launched the Roundhill S&P Global Luxury ETF, or LUXX, on the New York Stock Exchange to capitalize on this trend. The LUXX Lux ETF tracks the S&P Global Luxury Index, providing access to 80 leading luxury companies across Europe, Asia, and North America. Companies are selected for the index based on their size, as well as a luxury exposure score, which is calculated by S&P's equity research team using quantitative metrics such as revenues per business area, as well as qualitative factors such as market perception of their industry segment. It's therefore not surprising to see that within the top 10 holdings, notable names include the likes of Hermes International, LVMH, Mercedes-Benz Group AG, all of which are strong companies that have strong established brands and pricing power. Lux is one of the only 2 luxury ETFs listed in the US, and it also comes at a lower expense ratio of 0.45% relative to its peer. Next, Global X has recently introduced a pair of actively managed stock ETFs focused on Brazil and India. The Brazil Active ETF, or BRAZ, on the New York Stock Exchange, and the India Active ETF, or NDIA, on the New York Stock Exchange, were launched on 16 and 17 August 2023 respectively, providing exposure to 2 of the largest emerging markets. This comes as Brazil and India possess numerous potential growth drivers. Favorable demographics, encouraging structural and political reforms, abundant natural resources, and a shift to nearshoring are just some of the factors that have added to this long-term optimism. Looking at Brazil, for instance, it boasts a skilled workforce, abundant natural resources, and a quickly growing consumer market. Not to mention its central bank first raised rates to fight inflation in August 2021, several months before the US did so, and actually began cutting rates earlier this month due to an improving inflation outlook. For the Brazil Active ETF, companies are selected via screening for those with sustainable long-term business models, durable competitive advantages, businesses that are poised to benefit from long-term socioeconomic trends, and quality management teams. Here are the top 10 holdings, with notable names such as the likes of Petrobras and Vale. Meanwhile, looking at India, growth in India continues to benefit from favourable structural reforms, strong government spending, and low labour costs. Moreover, with attractive demographics, with the largest global population in the world and half of it being under the age of 30, India represents a significant structural opportunity for investors. Notable holdings include the likes of ICICI Bank Limited, HDFC Bank Limited, which are 2 of the largest banks in India, as well as information technology companies such as Infosys and Tata Consultancy. Both ETFs have an expense ratio of 0.75% and do not have similar actively managed peers within the ETF space. Back at home, CGS CIMB Securities has launched a new Vietnam-focused ETF on SGX on the 25th of August 2023, with FUGO Asset Management as investment advisor. The CGS FUGO Vietnam 30 Sector Cap ETF, or VNM, on the Singapore Stock Exchange, references the SGX IH Vietnam 30 Sector Cap, which tracks the performance of the 30 largest and most liquid Vietnam-listed companies by market capitalization. Vietnam is currently gaining relevance for international investors seeking diversification and long-term growth opportunities. In fact, the country has emerged as a manufacturing hub and is one of the fastest growing economies in Asia, given the shifts in global supply chains and strong domestic consumption driven by a growing middle class population. The SGX Vietnam 30 Sector Cap ETF is mainly invested in sectors such as financials, real estate, and consumer staples. The ETF, which offers dual currency trading in US dollar and Sing dollars, comes with a management fee of 0.99%. However, it is not the only Vietnam-focused ETF listed on SGX, with peers such as the FTSE Vietnam Swap UCITS ETF 𝗫𝘆 or HD9 on SGX, although we note that HD9 is a synthetic ETF, unlike VNM, which is a physical ETF. Last but not least, CraneShares has launched the CraneShares Dynamic Emerging Market Strategy ETF or KEM on the New York Stock Exchange on the 25th of August 2023. And this is to address evolving opportunities within the emerging markets landscape, while also highlighting the significance of China as a separate geography. KEM dynamically allocates between China and emerging markets ex-China, optimizing China exposure based on fundamental, valuation, and technical signals. China and emerging markets ex-China are represented in KEM by the CraneShares MSCI All China Index and the CraneShares MSCI Emerging Markets ex-China Index ETF. KEM begins with a baseline allocation that mirrors the MSCI Emerging Markets Index weightings, which is its benchmark, with China and emerging markets ex-China currently set at 31% and 69% respectively. This allocation is then dynamically adjusted, allowing for a maximum 30% overweight and underweights compared to the strategic allocation. Additionally, the strategy can allocate up to 10% to cash based on market conditions. The portfolio will typically be adjusted on a quarterly basis, although the model is continuously monitored, and rebalancing may occur more frequently if certain volatility or valuation triggers are met. KEM comes with a total expense ratio of 0.49%. Currently, looking at the current breakdown of KEM, we find that it is overweight China at 54% allocation at the moment. We remain bearish on China, as the country has deep economic challenges to overcome, including still fragile confidence, a worsening crisis in its property market, and potential troubles in its shadow banking industry. Besides, there are lingering longer-term structural issues to worry about as well, such as China's embrace of a top-down state-controlled economic growth model and shifting geopolitics. And hence, this ETF is a nay for us. And that's all from me today. Thank you very much for tuning in, and see you soon.